Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, August 1st, just after the close. Well, it had to be something, right? It was either going to be tariffs, it was going to be Bureau of Labor Statistics having to re-advise them. It was going to be something that created a little bit of supply, a little bit of pulling in the horns. We mentioned last week that it was awfully loud. Chatter, chatter, chatter from bears or people that were fighting this market for the last 2 months, 2.5 months, looking for that weakness. So we finally got it. What did we see? Wednesday was our first real eye-opener to some extent when we opened strong, closed weak. You've heard me say this before. Thursday, opened strong, closed weak. That's always a warning sign that into the close, volume is lightening up. Large sellers are lightening up. So we take notice of that. Friday, really you just needed an excuse to be a seller. And between Trump tariff talk and some labor numbers that were revised and didn't look good, you got an excuse to sell. And that's really what you saw today. If it wasn't one of those two things, it would have been something else sooner or later. And sometimes you have to shake the tree and see what falls down. Maybe a nice coconut will roll over to you. And that's what we'll be looking for. What's getting knocked down that's really just part of the market weakness and not on its own. And where we try to look for there is relative strength. What is showing some weakness but outperformance versus the market? And what bounces back first? Those are the names we want to be involved in. We have some cash and tactical trend off of the sales that I mentioned over the last couple of weeks. Last week we covered the GEV sale. By the way, that went up this week. So, you win some, you lose some. In terms of the sale, we'll take that anytime. But we do have that cash available. Where are we going to look? That's what the market will dictate. We can't purely say we're going to look at tech, we're going to look at consumer non-discretionary, we're going to look at X, Y, Z. What shows itself to have some demand over the next 2, 3, 4, 5 sessions, over the next 2 weeks? August is typically a little bit volatile. And you saw the VIX run up through 20 today. The VIX just tries to give a snapshot of the expectation of volatility over the next 30 days. So volatility's picked up. It's been very quiet. It's nice to see. It may sound odd that I'm saying it's nice to see. We need volatility. We need days like this to reset expectations and create reasonable entries. It's dangerous to always chase. You make a sale and you're having to chase something else. We'll let things resettle here and we'll identify where we have a risk-reward ratio that makes sense. So 1 day, 2 days, it's really a 2% pullback off of all-time highs. So in terms of what we're looking for, I'd love to see just a little more choppiness, a little more volatility. Let it pick up a little bit. Let some investors, some traders get a little bit worried, a little bit scared. That's when you get price dislocation, things that aren't priced right. If everything's priced to perfection, it's tricky to get an entry. So we'll be looking for some entries. In terms of what we'll look for from the moose on the bond side in a few minutes, boy, what a nice tailwind in the Treasury market. Munis followed up. Nice to see a bid in bonds. It's been one of those years that we've been fairly consistent, that we thought the 10-year would trade, somewhere between 3.8% and 480, that 100 basis point window. And that's where it's been. But in terms of performance and return, you're just leaning on coupon there. And if your coupon gets eroded by any backup in rates, your total return can be affected. So I like to see rates falling. Should be helpful to multi-asset classes. And next week will be interesting. In terms of August in general, volume's down a bit. We'll see what comes to us. Moose, take it away.
Hi, I'm John Musso. I am the Chief Investment Officer at Cumberland Advisors. It is Friday afternoon on August 1st. This is the bond report. Big week in bonds. This is why. A few different things. Number one, the Fed kept short-term rates where they had been. So you had 4.25 to 4.5. That's where they have been since the beginning of the year. There was talk about possibly a quarter-point rate cut. Didn't happen. First time in 30 years. You had two formal dissents from two governors, Chris Waller and Michelle Bowman. They both favored a quarter-point cut. Usually in these things you have unanimity. So the fact that you had two dissenters, a little bit scratches your head and you say, what do they know that everybody else knows? Their thought was that the economy was starting to show some signs of weakness. Today, we had a jobs report that you would think shows a little bit of weakness. We had a jobs report where the expectation was going to be up around 100,000 or so jobs, came in at 73,000. More importantly is that you had last month's jobs numbers revised down. It was a surprise number last month, if you remember, at 147,000. What happened? It got revised down to basically 14,000, excuse me. That is one heck of a drop. And when you look at those numbers together, it makes you look at a few different things under the hood. Manufacturing jobs down, service-oriented jobs down. You're starting to see possibly the effects there of federal government cutbacks now. We know the Doge workers, the Doge people were out cutting jobs earlier in the year, and some of that severance is done. So all in all, a jobs number that really surprised the market, that was looking for, something, up 100,000 further north. What was the effect? Bond yields dropped a lot. The 10-year bond, as we sit here, is around a 421. That's down 20 basis points today. That is down, but call it about 17 or so basis points for the week. 439 down to that 422 level. And the 2-year bond, which is probably the most sensitive to changes in the expectations for short-term interest rates, that was down a full 21 basis points just today, from a 393 to a 372, pardon me. Does this last? We don't know. We know the reason that the Fed did not cut rates is they want to see surety of inflation and whether it's being affected by tariffs. You had a PCE number this week. We know that's the Fed's favorite measure of inflation. Came in on target, but if you look at the year-over-year numbers, since the end of the first quarter, they have trended up. So those year-over-year numbers had been at 2.3, they're at 2.6. So on one hand, the Fed is cautious about where that inflation is. On the other hand, the economy is been doing what it's been doing since the beginning of the year, and that is slowing down gradually. And it really doesn't matter what categories you want to look at. They've all have slowed down somewhat, with the exception of technology, as we know, looking at the stock market. As you go forward from here, we'll continue to see this tug of war go on. The Fed does not meet again until September, but it's interesting, if you look at the Fed funds futures market, you went from pretty much a consensus that you might not even get a cut in September to now about an 85% chance that you will have a cut. So there's a big shift in sentiment, and it only took one jobs report to do that. The muni market very well behaved this week too. Yields down across the board, not as much as treasuries. And when you get these fast movements in bond yields, and in this case downward, nothing keeps up with treasuries. And this week was no exception. However, the 10-year AAA scale down from a 334 down to a 325. Shorter term yields down also. And most importantly, pretty good reception on all the deals this week that came. And on top of that, you did see flows into bond funds. So a good week for bonds overall. We will be watching this next week. Certainly, in the summer doldrums, this was a week full of information, and today was a surprise for the market. And the one way you can tell the market was pretty surprised is that 10-year bond had really stayed within a pretty narrow range the whole week, in between a 442 and maybe a 435, and then today, boom, down it goes. We'll have more next week, and we hope you have a great weekend. Thanks a lot.
Boy, John's so subdued in that video. I thought he'd be doing a little jig with the bond market stronger. We'll see you next week. Enjoy the weekend.